Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. The macro domino effect, AI, debt, and the semiconductor squeeze. This video presents a direct informational narration of the source document. Okay, let's dive right in. Today we're exploring a really fascinating intersection of global macro trends, geopolitical shocks, and this massive wave of AI capital expenditure. So I want you to think about this number, 320,000. That is the staggering amount of highly leveraged retail accounts that were recently forced into liquidation over in South Korea. I mean, it's a stark, real-world illustration of the extreme dangers of market leverage and speculation. And honestly, it sets an absolutely critical backdrop for the broader macro domino effect we're unpacking today.
Here's our roadmap for today. 1. Global pressures. 2. Korea's margin call. 3. The AI debt engine. 4. The free cash flow squeeze. 5. A potential capex cut scenario. And 6. The semiconductor outlook.
Section 1. Global pressures and rates.
Right now, we're seeing several immediate global catalysts putting pressure on markets. Geopolitical tensions in the Middle East have escalated, which has driven Brent crude oil prices up by 9%, pushing it right back over that $80 mark. And alongside that soaring oil, we're hearing hawkish signals from the Federal Reserve. Fed Governor Waller essentially indicated that if upcoming core inflation data strengthens, near-term rate hikes could absolutely still be considered. Because of these combined factors, markets have basically priced in a greater than 70% probability of a September rate hike.
Section 2. Korea's margin call crash.
The South Korean market just went through this historic plunge. The KSPI index dropped completely below the 7,000 mark. Now, to really grasp the sheer scale of this volatility, let's look at the circuit breaker mechanism. Since it was first introduced back in 2000, there have only been 13 total triggers. But get this, over 50% of those historic triggers happen in just one single year, with the 7th circuit breaker of 2026 triggered in July. That points to a highly unusual and dangerous market extreme.
The actual mechanics behind this brutal margin call are just staggering. Korean retail margin balances were sitting at 132.47 trillion won on June 29th. Literally just a few days later, by July 9th, that balance plummeted to 107.1 trillion won. That means roughly 30 trillion won simply evaporated, just gone. That's exactly what triggered the forced liquidation of those 320,000 retail accounts we talked about earlier. And you know the truly scary part? If the market drops another 20%, it's expected that even more of these leveraged accounts will be wiped out entirely.
Section 3. The AI debt engine.
Okay, let's pivot to the US, where we're seeing immense corporate debt being accumulated by big tech to fund massive AI expansion. We're talking about just 6 major tech companies. Giants like Amazon, Google, Nvidia, Meta, and Oracle, issuing over $120 billion in debt so far this year alone. To put that into perspective, this staggering figure represents nearly 15% of all U.S. corporate debt issuance. Honestly, without this massive influx of debt financing for ongoing capital expenditures, the current AI expansion might have already stalled out completely.
You can think of this AI debt a lot like real estate debt. If you borrow heavily to buy a house and the house price rises, you're perfectly safe. But if housing prices suddenly drop, that debt becomes fatal. It's the exact same logic here. This AI capital expenditure debt is perfectly manageable as long as these companies continue to see their free cash flow rise. However, if AI monetization fails to keep pace with all this spending, this debt burden is going to become a really critical systemic risk.
Section 4. The free cash flow squeeze.
Right now, the market consensus expects that tech free cash flow will actually bottom out in 2026. This makes 2026 the pivotal verification year for AI monetization. Everyone is assuming a strong rebound in 2027, followed by massive growth in 2028. But here's the catch. This incredibly optimistic outlook relies entirely on AI revenue actually keeping up with these aggressive, debt-fueled spending schedules.
So what happens if those massive revenue expectations just aren't met? Well, it triggers a very dangerous negative feedback loop. Step 1. Free cash flow falls short of projections. Step 2. Because those massive capex commitments and huge depreciation costs are fixed, profit margins get severely squeezed immediately. Step 3. As balance sheets tighten up, the credit risk for these massive tech firms starts to rise. And finally, Step 4. This leads to surging borrowing costs, which effectively forces these giants into a toxic cycle of high-interest debt just to maintain their existing commitments.
Section 5. The CAPEX cut scenario.
Now, if tech companies want to avoid that catastrophic debt cycle, they might be forced into an extreme pivot to save their balance sheets. That basically means slashing AI spending far beyond what the market is currently expecting. While investors have already priced in a mild slowdown, a scenario where 2027 capital expenditure actually shrinks compared to 2026, that would force a massive market-wide repricing of semiconductor earnings.
And this leads to a very stark warning from the source material. If AI monetization broadly fails, it could actually trigger a crash worse than the 2000 dot-com bubble. Why is that? Well, it's because today's global economy, government debt structures, and corporate dependencies are far more heavily reliant on this specific AI investment boom than they ever were on internet companies back in 2000.
Section 6. Semiconductor Outlook and NVIDIA. Bringing this back to the technicals for a moment, if we contrast two major U.S. semiconductor indices, we see a pretty interesting divergence. The SOXX index is currently facing some friction. It really needs to hold technical support levels around 554 and 582 to regain an upward trajectory. Meanwhile, the SMH index, which holds different structural components, is showing diverging price action. It's tracking a 557 support level, but is currently trading higher, around 585. The key takeaway here: we're seeing high volatility for sure, but structurally, the U.S. market is missing those extreme liquidation risks we're currently seeing in Korea.
And that's a crucial distinction. Unlike the highly speculative, retail-driven market in Korea, the U.S. semiconductor market benefits heavily from deep institutional participation. Because of this, the current volatility is largely viewed as normal pullbacks rather than an impending systemic margin crash. Looking specifically at NVIDIA, despite all the market noise lately, the company still maintains a massive 80% market share. Plus, its current valuation metrics are actually hovering around their lowest levels since 2019. That suggests solid fundamental backing, even amidst all this volatility.
So ultimately, it all comes down to one massive question. Will AI monetization outpace this massive debt, or are we facing a historic reset? As the source document concludes, navigating this environment requires clearly distinguishing between long-term investing based on fundamentals and short-term speculation driven by leverage.